You've probably been paying your tax bill to the wrong account, not because you did anything wrong, because nobody ever explained the actual choice you're making every time money goes into your retirement account. There are two accounts almost every American has access to, a 401k and a Roth IRA. Most videos treat them like rivals, like you're supposed to pick a side. That's the wrong way to think about it. And by the end of this video, you'll know exactly which one to fund first, second, and third. Here's the easiest way to actually understand this. Picture retirement as one long, expensive meal. The IRS is your server. And here's the part nobody says out loud. Your server always gets paid. The only real question is when. That's the entire decision. Every dollar you put toward retirement, you're choosing whether the IRS collects now or collects later. Start with the 401k because your employer runs this table, and sometimes they'll buy you an appetizer. That's the match. Say your company matches 50 cents on the dollar, up to 6% of your salary. If you're only contributing 3%, you're leaving free money sitting on the table. Not a discount, not a bonus. Actual cash that's yours if you just ask for it. In 2026, you can put up to $24,500 into a 401k in a single year. If you're 50 or older, add another $8,000 on top of that. This is a big table. Big enough that for most Americans, the bulk of their retirement savings lives here. But there's a catch. With a traditional 401k, you eat now and the check comes later, whenever you start withdrawing in retirement. Nobody knows what tax rates will look like by then. You're essentially betting that your tax rate in retirement will be lower than it is today. Sometimes that bet works out. Sometimes it doesn't, especially if your investments grow a lot and push you into a higher bracket later. Think about it this way. Say you contribute $500 a month for 30 years, and it grows to $700,000. Every single dollar of that $700,000 is still technically owed to the IRS. You just haven't paid the check yet. The bigger the meal gets, the bigger that final bill can be. So the 401k is the pay later side of the table. Now let's look at the account where you settle the bill up front. A Roth IRA flips the order. You pay the tax bill today, at today's rates, before you've even sat down. After that, the meal is free. Forever, every dollar of growth, every dividend, every gain your investments make over the next 30 or 40 years. None of it gets taxed again. Not when you withdraw it, not ever, as long as you follow the rules. The catch here isn't the taxes, it's the size of the table. In 2026, you can only contribute $7,500 a year to a Roth IRA, or $8,600 if you're 50 or older. And if you earn too much, the IRS won't even let you sit down. Single filers making over $153,000 start losing access, and above $168,000, you're locked out completely. Married couples filing jointly lose access somewhere between $242,000 and $252,000. So here's the actual trade-off. The 401k gives you room, and sometimes free money from your employer. The Roth IRA gives you a genuinely tax-free future, but a much smaller seat at the table. Here's the part that surprised me while researching this video. Over 85% of 401k plans offer some kind of employer match. but roughly 56 million private sector workers in America don't have access to a workplace retirement plan at all. No table, no free appetizer, nothing. And if you do have access, 2026 quietly changed a rule that matters. If you earned more than $150,000 last year, your catch-up contributions to a 401k now have to go into the Roth version, whether you wanted the upfront tax break or not. The IRS is nudging higher earners to pay the bill now instead of later, and most people haven't even noticed. So which one should you use? Realistically, you're probably not choosing just one. Here's the order that works for almost everyone, in almost every situation. First, contribute enough to your 401k to capture the full employer match. That's a guaranteed return before you've invested a single dollar in the market. Skipping it is like turning down part of your own paycheck. Second, if your income qualifies, fill up a Roth IRA. It's smaller, but it's the one account where your money grows completely untouched by whatever Congress decides to do with tax rates in 20 years. Third, if you still have money left over to save, go back to the 401k and push toward the max. Here's why that order matters. The match is free money you can't get anywhere else, so it always comes first. The Roth IRA comes second because it's capped low and income limited. So if you qualify this year, use it before the door closes. The 401k max comes last simply because there's no cap on how useful more room is, so it soaks up whatever's left. This order isn't a guess. It's based on what gets you free money first, tax-free flexibility second, and raw savings volume third. Quick disclaimer. This video is for educational purposes only, not financial advice. Your right mix depends on your income, your employer's specific plan, and how far you are from retirement. Talk to a tax professional before making any big moves. But now you know the real question behind Roth IRA versus 401k. It was never about which account is better. It's about when you want to settle up with the IRS.